Understanding tax-deferred investments. Hello, everyone. Today we're going to dive into a term that often pops up in financial conversations: tax-deferred. If you're looking to make the most of your investments and savings, understanding this concept is key. So let's break it down together. Tax-deferred refers to investments on which applicable taxes are paid at a future date instead of in the year the investment earns income. When you have a tax-deferred investment, your money can grow at a faster rate since you're not cutting into its growth each year with taxes. This can be a powerful tool for long-term financial planning. Imagine you have a garden. In a regular tax scenario, you would have to give away some of your crops each year. But in a tax-deferred situation, you get to keep all your crops and replant them, allowing your garden to grow much larger before you have to share any of it with the government. Common types of tax-deferred accounts include 401(k)s, IRAs, and annuities. With these accounts, you typically pay taxes only when you withdraw money, usually during retirement when you may be in a lower tax bracket. The primary benefit of tax deferral is the potential for compound growth. However, there are rules and limits to consider, such as withdrawal penalties and required minimum distributions. It's crucial to understand these before diving in. And that's a wrap on tax-deferred investments. With this knowledge, you can make more informed decisions about your finances. We hope you found this video helpful. Happy investing, and see you next time.